So procurement process, and I want to pick up with just a kind of a brief review of where we were to help get your brain back into this. We had talked about the way master data is thought of and managed in the vendor master record. And there were some questions on the midterm about this that some of you did well on, but among the more missed questions was at least one question related to this. And the idea here is we have the vendor master record, and there's some general data that's universal throughout the client as it relates to this particular vendor. That's going to be the name of the company, their address, their phone number, basic things like that. But when we look at accounting data for a particular vendor, accounting data is segregated based on company code. I seem to recall that there might have been a true-false question on the midterm that said something along the lines of, in the vendor master, accounting data is segregated based on purchasing organization. And that was an incorrect statement. When we look at a particular vendor master record, depending upon the company code, we're going to see different accounting data. The accounting data here, of course, is what we owe that particular vendor in terms of accounts payable, and then transactions that we have concluded with them but still show up in our accounting records. When we look at the specifics of our purchasing relationships, of course, accounting is focused on money. Purchasing is going to be focused on what particular products we bought, the quantities of them, and other things of that sort. That is going to differ based on purchasing organization. So one company code could have and likely would have multiple purchasing organizations, but each of those purchasing organizations would maintain their own purchasing data as it relates to information with a particular vendor. And I think last time we left off with this slide right here, where we were just illustrating, here's company code C101. From an accounting perspective, this top left diagram and the top right diagram are exactly the same. But from a purchasing perspective, this portion of the vendor master record is going to look different depending upon whether we're purchasing organization P999 or purchasing organization P997. So this slide right here, which is the first new one for us, gives us a little bit more detail as to what exactly is differentiated by these three elements. So as I mentioned a moment ago, the client data, name, address, communication, the number for that particular vendor, their account number, that's general data, universal throughout the client. Company code data, we're going to see accounting information. So this is going to be the reconciliation account, various banking information, information about payment terms, communication dunning. This is a typo. This is my oops right here, because I was not thinking vendor master, I was thinking customer master, which we will ultimately see in the near future and greatly resembles this, but an inverse set. We don't have dunning information in the vendor master record. As an aside, we'll talk about this in the future. Dunning is the process of how you manage late accounts. You call someone, you send them a letter, you progressively get more aggressive in collecting past due amounts. That has no part of this because we're the buyer here, not the seller. So that should not be there. Purchasing data, as I was talking about, we have things related to our purchasing interactions. And the two things that are listed there, partner functions and Incoterms, are new things for us to talk about. So let's talk about those this morning. Partner function, what is that? That is a general term that we use to describe information that we have to keep track of just in order to handle the logistics of doing business with another company. So we will see that this, in fact, is something that is used, this term is used for both customers and vendors. And the idea here is very straightforward. There might be a company that we buy from with great frequency. and they have 5 salespeople. And when we want to buy these kinds of products, we talk to Bill. And when we want to buy these other kinds of products, we talk to Sue. Where do we keep track of that? That is all stored in the context of partner functions. And so there's a part of the vendor master record that really allows us to do a lot of free-form typing of text and capturing basic things like names of people and their contact information and their role in the organization. Many, many years ago, I used to train, ironically, I used to teach courses both in purchasing and selling. And one of the things that I used to talk about in my purchasing course was when you're work for a company and you're a buyer, don't just get to know your salesperson. If it's an important relationship, get to know your salesperson's supervisor. Because that way, if the salesperson ever gets replaced, you still have a relationship with someone at that company. Well, that's the idea here. We want to keep track of facts about the people that we deal with on a regular basis for those companies that are very important partners of ours. And certainly, companies that we buy from fall into that category. You know, so they might call us up one day and say, hey, just so you know, we're moving our accounting office to another location, so when you send payment, please send it to this other address. Well, that's the kind of thing that would go into these partner functions to make sure that we handle our relationship appropriately. The other term here that's a part of this is Incoterms, and perhaps some of you have seen that term before. We do talk about this a little bit in the 3720 course for those of you that have taken that. Those of you that are business students, you may have seen this in other contexts as well. But one important element in every business transaction is where in the transaction does title pass? Or more colloquially, we could say, where does ownership shift from one party to the other? When I buy an item, at what point does it stop being the seller's property and start being my property? Great example of that would be you contact Amazon and you order something from them. They ship it to you and it shows up in a box on your front door and looks like it's been stomped on by a football team, okay? You would probably not be real happy if you contacted Amazon and they said, hey, that's on you. It was fine when it left here, so whatever happened to it in transit, that's your tough luck. That would probably not make you very, very happy. Well, in business transactions, one of the things that businesses need to work out in advance is exactly where does ownership pass in a given transaction. And the uniform term that is used to describe this is Incoterms. Now, there are a variety of standard Incoterms that you will see represented on sales and purchasing documents. And so we'll go through the more common of these. Exworks, usually abbreviated EXW. And what Exworks means is that the seller makes the goods available, but that's it. They don't load it onto a truck. The seller does not transport it. The buyer bears all the costs and all the risks of delivery. The institution I used to work for in the past ran a lot of, just like on this campus, ran a lot of residence halls and other buildings where there were a lot of paper consumables such as paper towels and toilet paper and other things like that that were consumed on campus. The university had its own semi-truck, and so as a cost-saving measure, once or twice a year, that truck would drive to Green Bay, Wisconsin, and pick up a semi-full of paper products and drive it back. And by our transporting it ourselves, we saved a lot of money. So in that situation, you place an order with the company, and they say, okay, come to our factory and get it. And we'll make it available to you. You have to take care of loading it onto your truck. You have to take care of transporting it, and you have to take care of all of the cost and risk of delivery. But the idea here is that the price I'm going to quote you is reflective of that. So I'm going to be able to sell this to you at a lower price because you, the buyer, are on the hook for really the whole element of logistics here. And believe it or not, depending upon what we're talking about, as far as the item itself. You know, loading is, for most items, probably not going to be a significant expense. But the elements of this that could bear a significant expense, number one, is the transportation costs itself. But then number two, this risk of delivery. How do we offset risk of delivery in this situation right here? What do we typically use to offset risk here? Insurance. Okay, so we're probably going to have to buy insurance here in the event something catastrophic happens. If it's a small purchase, we might just roll the dice and not worry about it. But if it's something expensive, you know, we're buying $2 million worth of computer equipment, Exworks, well, we would have to buy insurance on that delivery, and we would bear the cost for that. So because we, the customer, are bearing more of the cost, the vendor gives us a better price for it. Free Carrier FCA. In this scenario, the seller delivers to a designated carrier at a named location. So we might say, for example, we will buy this for you, Free Carrier. We would like for you to take it to the port of Charleston and deliver it to this particular shipping company, and they're going to load it on a ship and bring it to us, I don't know, let's say in Miami, for example. I don't know that using a ship for that makes a lot of sense, but we'll just assume it does for my example here. This could also be, you know, you will deliver it to such and such a trucking company on the other side of the city where you are, and at that point, once you give this to this other designated carrier in a particular location, at that point in time, title passes. So notice what we're focusing on here is, at what point does it stop being your property and start being mine? And just imagine if at some point the items were all to spontaneously combust, who just lost out in this situation is what we want to be prepared for here. Free alongside ship, FAS. The seller delivers to a designated seaport and title passes upon arrival at the origin port. You know, ships are really fun, and we won't go into this in great detail here. But with ships, if you've ever been to a shipyard and looked at them loading stuff onto barges and other things, it's quite an operation. And there are actually Incoterms for, as we see here, you get it to the port, and then at that point, title passes. So what happens if the seller delivers it to the port, and it's sitting there next to the ship, and the crane comes, and it picks the shipment up, and is in the process of loading it onto the ship, and all of a sudden the crane slips and dumps the stuff in the ocean, or even just drops it hard on the deck, damaging it. Well, all the seller had to do was get it next to the ship. Once it was there, it's now mine as the buyer. So free alongside ship is literally what it says. You get it alongside the ship, and then at that point, that's where title actually passes. So this Incoterm is actually sea travel specific as opposed to other modes of delivery. Free on board is perhaps the most common one that you will see. In free on board, the seller puts the items on a transport vehicle, and then there is a designated location specified where the title will actually pass. Now, this can be written either very generically or very specifically. For example, you might see FOB shipping point. Or you might see FOB destination. Now, FOB shipping point means title passes at the point of shipping. FOB destination means title passes at the destination. So you have to think about this a little bit, not because it's complicated, but just because it could potentially be confusing. Which of those carries the maximum risk / cost for the buyer FOB shipping point or FOB destination? FOB shipping point. And similarly, the one of these that carries the most cost for the seller is FOB destination. Now, sometimes it's written just this way. Sometimes, though, it might be written FOB Atlanta. And maybe the customer or the seller is in Atlanta, or this could be, you know, FOB Nashville. And the presumption is here that those are cities that make sense in the context of the businesses that are actually doing the buying and selling. Yes, sir.
I don't really know if it's relevant or not, but would there ever be an example, for instance, you're shipping something from Nashville to Toronto, and would there be a, I guess, transfer of title at the border of Canada and the United States, maybe?
Absolutely, that could happen. Now, sometimes that will happen in the context of free carrier, where we might take it to a designated shipper that's pretty close to the border between those countries. And, you know, if you've ever traveled, like from the United States to Canada in particular, you know that right across the border on both sides, there's a lot of warehouses and shipping depots and things like that for exactly that reason. So yes, that would be very common. You could do that with an FOB designation, but you could also do it with free carrier as well. But yes, the key here is you could pretty much do anything you want. These are the common ones, but the intent is to have clarity. Because although you hope this never happens, should there ever be a problem, we don't want there to be a lawsuit. And if there is a lawsuit, we don't want there to be confusion about this. We want it to be very clear on the part of both parties as to how this is going to play out.
Pretty much like what I'm saying, anything, you can do anything you want as long as both parties are like in agreement with that.
Absolutely.
You have something as ridiculous as the title transfers on the third full moon of the year or something.
I mean, I'm not going to say that particular one is common, unless maybe we're buying some kind of like astrological stuff or something. But yeah, the key is if I'm the buyer, this is going to be on my purchase order. And if they accept my purchase order with it on there, then that's the terms. Now realize they always have the ability to reject my purchase order. They might say, we don't keep track of the phases of the moon, you know, give us some other criteria here that makes sense, and we'll do it. But if you're placing a big order with a company and you want something, I'll give you an example. The company that one of the companies I used to work for, their logo was an owl. And they actually, this is going back decades, shipped their product internationally, and it went through one port where the people that worked in that port believed that owls were unlucky and they refused to handle the boxes. And so the purchaser had to say on their purchase order, either cover up your logo or put it in plain brown boxes, because otherwise it's never getting to us. And we had to specially box their items for them. If they're placing a big enough order, as long as their check clears, we got no problem doing it. You know, that's kind of the attitude here. So yeah, this gives us the ability to be very specific about that. Cost and freight, CFR. The seller pays the cost and the freight to bring the goods to a named location, but the buyer bears the risk once the items are shipped. So this is kind of interesting. The seller says, look, I will pay for the truck to take it to you, but if something happens to the truck, you're going to be responsible for it, so you buy the insurance. You know, if you've ever bought or sold anything on eBay, that's another environment where stuff like this sometimes comes into play. And one of the key elements in those transactions often is, you know, is insurance going to be involved? Who's going to pay for the insurance? Same scenario here. In cost and freight, the seller says, we'll pay for the shipping, we'll pay for the freight to get these items where you want, but you as the buyer, you're in charge of handling the risk here. Oftentimes, the reason why this is done is we might be shipping this using a third party, let's say trucking company. And so, sure, we'll pay for the trucking, but you take care of the insurance. It's kind of a compromise here to share the costs between the parties. And then you have CIF, cost, insurance, and freight, where this is they're going to pay for the cost of shipping it, and they're also going to pay for insurance. So notice, interestingly enough, in this one, you're actually specifying that the seller has to buy insurance for this. In other ones of these, the seller could elect not to if they were so inclined. But CIF actually requires them to purchase insurance for the shipment. There are a wide variety of other Incoterms. Well, there aren't a huge number more than we've talked about, but there are more. And I've put a link to an older, this is going back over a decade ago, that SAP put together this particular help document. But you notice it lists all the common Incoterms. What's really interesting about this is the reason why they're called Incoterms, the IN part of that stands for international. You see, Incoterms is international commercial terms. So these are actually regarded universally. If you were doing business with a company in China or Italy or Canada or Mexico, you could use these terms and they would have a standard agreed upon meaning in that context. Just to show you this in the context of SAP, because this is kind of a very interesting example of internationalization that we can observe. And so let me log on to the SAP GUI here real quick. There is a table in SAP that shows the various Incoterms that are available for us to select, and it just happens to be table TINCT. So give me a second to pull this up for you. Execute. Okay, here's all the Incoterms that are available, and if we look here, the ones with the E next to them, that's English, and there's the abbreviations we just talked about along with the text associated with it, so you see them there. But notice if we scroll down here a little bit further, here's those same Incoterms, but with text in, I think, P is Portuguese. Here's R, Russian. You see that, I think that's what the Cyrillic alphabet being used there. Same letter abbreviations, but obviously different text associated with it that are available universally in our transactions. So this is something that you will see on purchase orders that we generate in our organization. Yes, sir.
Earlier in our talks, were there not abbreviations that didn't really make sense to what they were talking about? So why would we?
I guess this is one of those situations. Keep in mind, these are not things that SAP created. These are international business things. And this just happens to be one of those times when English was the agreed upon standard. Depending upon the era of time that we're talking about, you go back a couple of decades and English was the language of international business. And if you met anyone who conducted business internationally, they might be from another country, but chances were really good they were fluent in English. So you see a lot of that. As time has progressed, the world has become more global, and I don't know that that is as universally true as it might have been, but you still will see a lot of abbreviations that are English that are used around the world commonly, and this is one of those examples. Other questions, comments? Yeah.
FOB shipping point and CFR, both the buyer bears the risk once the items are shipped. The biggest difference is that the seller is going to, with FOB shipping point, is the customer paying for the transport? Is that the difference, since the seller pays cost of freight?
FOB shipping point means that the customer would pay for transportation, and they would be on the hook for buying insurance if they want to. Mm-hmm. The idea here between CIF would be something like this. Let's say I'm selling something to you, okay? I am going to have to pay to get it to you. But in addition to that, I have to buy insurance. and I have to designate you as the recipient of the insurance. So if the truck blows up halfway between me and you, the insurance company cuts a check to you. In FOB, we might have a similar situation, but because there's no requirement for insurance, I might be still responsible for it, and then you've got to come against me to try and get money and so on. The idea here is the insurance company kind of acts like a neutral third party and will probably pay very, very quickly. And realize, of course, it's not like insurance is going to go along with every transaction, but for certain things, if it's expensive, that really works in our favor. All right. Other questions? Yeah.
With specifics around to what extent does the information that is being gathered by the paper of that order where the title ships from manufacturer to buyer, to what extent is this information spent in real time? Not just say, hey, deliver it, you scan it, and then it updates the system that, hey, this is no longer a sub, that kind of thing. How well do they have that information in real time? Right away that, hey, this is no longer a sub.
First of all, the step in the transaction where title actually, where we say we don't own this anymore, it comes to our it belongs to our customer. I suspect we'll see this at some point in our discussion. It's called post goods issue, where post here doesn't mean post as in after, it means post as in make an accounting posting. And so when we post the goods issue, that means we don't own it anymore. Title has passed. So your question is, is that something that title might have passed last Tuesday and we go into the system today and enter it and it's not exactly happening in real time? It's very much going to depend on our organization, practices common to our industry, things like how sensitive the materials are. If I'm shipping tightly regulated pharmaceutical products, I probably keep very, very tight reins on that, and I want to make sure that it's very precise as far as when title passes. If I'm sending you a truckload of paper towels, we could go back, and if there's ever a contention, we could figure out where title passes. But you might have picked them up on Tuesday, and I don't actually click the post goods issue button until Wednesday. So this is where industry practices and the nature of the product itself might dictate it. But we're not yet in some organizations are using things like RFID tags, where that does allow them to almost in real time capture things like post goods issue. But we're not yet in a world where everything is that precisely tracked. Other questions or comments? Yeah.
I guess kind of playing off what you're saying, I would figure that there would be some kind of physical, like, post-goods issues, for example, like signing for a package, so that even though in your system it hasn't been updated, you still have a physical piece of paper that says it has passed.
Actually, absolutely. Yeah, and that's what I'm talking about. Maybe there's a question about a shipment, and the definitive answer might not come until we go to the UPS website and look at the tracking information. That's exactly why UPS makes you sign for things in some instances, or even when they don't sign for things, they have barcodes on things, and they have guns that, will read the barcodes and such. It's for exactly those kinds of reasons. So yeah, as our ability to track things gets more and more fine-tuned, it eliminates a lot of ambiguity here, because we can almost go back and recreate the path a package followed as it moves from one entity to another. Your trucks maintain logbooks, there's inspection stops. I mean, if you really wanted to, you could dig back into something and learn a lot about it. And oftentimes, if everything plays out the way we expect it to, we don't care. But if there's ever a problem, then this is where we have people that are going to investigate, and perhaps lawyers get involved, and we reconstruct it and figure out exactly how this should play out. But probably 99% of the times when we do business, we don't even have to worry about it. Other questions? These are good questions. All right, so we are talking about master data relevant to procurement. We talked about the material master, I don't know, a couple weeks ago at this point. We just wrapped up talking about the vendor master. Now let's talk about something called the purchasing information record. Purchasing information records and their complement on the selling side are very, very useful in capturing things that are very important to us in our business processes. And I really want to come back to the theme that, you know, if you were designing an enterprise information system from the ground up, it would be really, really easy to oversimplify things and limit the way people could use your software. But because SAP is a mature product at this point that's been through many versions and been used by thousands of companies, there's been a lot of things added to its functionality over time to really maximize our flexibility. So the material master is where we have all of our information about our materials. The vendor master is where we have information about our vendor. But suppose there's information that we need to keep track of that's almost a hybrid of those things. We want to record information about a material, but in the context of a particular vendor. And the purchasing information record is where we can do this. This record, this master data record, which by the way does not have to exist in every instance, but this is where our vendor data and our material data have the ability to come together. And so the material master contributes some to this, the vendor master contributes some to this, and this is called a purchasing information record. What we have here is information that is a combination of vendor information and material purchase from that vendor. And we have the ability to have just general notes. We can keep track of purchasing information. We can keep track of conditions. We can keep track of vendor data. We can keep track of texts and notes. Let me give you maybe an overly complex example. We have a particular material that when you look in our system, this is material MT147. And so we have a material master called MT147. And it's something we use in manufacturing, and we use it all the time. And so everybody in the company knows if we say MT147, they know what we're talking about. Well, that number, MT147, actually came from a vendor that we used to buy that product from. And they named it MT147, and we bought it from them, so we called it MT147. Well, about 20 years ago, that vendor went out of business. And so we had to find another vendor. And we did find another vendor, and they made a product identical to MT147, but their product was called QZ186. But you know, all of our documentation in our company is based on MT147. Everybody already knows that code and is focused on it. So what we want to be able to do is we want to still call this MT147. And as a matter of fact, we want to be able to let somebody in our factory put in a requisition for, I need 10, I don't know what this is, 10 gallons of MT147. So they turn in a requisition for 10 gallons, I don't know why that says 1 gallon, 10 gallons of MT147. That's on the purchase requisition. When the purchase requisition gets processed, we say, oh, you call it MT147, but we're going to order it from this vendor over here, and when we order it from that vendor, we have to call it QZ186. So there's a translation between our material number and the vendor's material number. You might say, well, does that happen that often? No. But if we need to do that, the purchasing information record is where we do it. The purchasing information record lets us say, okay, here's how we normally handle this material. But when we're doing it in the context of this vendor, there's some special things. There's some differences. The purchasing information record is where I can record those differences, okay? So going back to where I said that this is a very nice design element for us, you know, we have the material master, which stores all our material information. We have the vendor master, which stores all of our vendor information. And if there's ever a material that we need to do some kind of special deal with, we need to keep track of data separately, we need to in some way handle it in an atypical fashion for the vendor, that's all going to be represented here in this purchasing information record. The purchasing information record is where we can go and also find out about facts as it relates to our purchases made from a particular vendor, but it also gives us a place to kind of handle those out of the ordinary circumstances. Any questions about this? All right, so we are almost done with master data. We have one very last, very important piece left, and that is conditions. Now, when you hear conditions, you know, in your mind, you probably could more easily transition that or translate that to prices. And I think we've made this statement before. You go to the store and you see a price on a particular product, and that's what you know you have to pay, unless you're buying, let's say, a car, and then you might engage in negotiation. But for the most part, a price is a set thing that is always going to be the same across multiple transactions for a given product. But in a business setting, prices are very flexible and dynamic. And in fact, what we will do and what we want to have the ability to do is to create price schedules and to create rules that can be used for price determination. Now, let me tell you, these rules can be virtually anything we want them to be. There are some very common things upon which we create these rules. For example, we might say the standard price for this product is $1.50 a unit. But if you buy more than 50, the price drops to $1.45. And if you buy more than 100, the price drops to $1.40, and so on. So we could have a pricing schedule that would be based on the quantity purchased. That's an example of a rule, and we could set those rules up. We could also have rules that don't focus so much on how much you have bought right this minute, but how much you've bought maybe this year. And we might say, okay, this year, when you're buying, you know, up until the point where you buy 1,000 units, the price is going to be X. But then after you've bought 1,000, from 1,000 to 5,000, all the units you buy in that spread are at a different price. And so it's based on your cumulative purchases. We could also create pricing rules that say, how many units do you think you're going to buy this year? And you say, we think over the course of this year we'll buy 50,000 units. And we say, okay, if you sign a contract that says that you agree you'll buy at least 50,000 units, we'll sell them to you at this price. If you buy that many, life is good. If you don't wind up buying 50,000 units, though, you're going to have to pay a penalty, and you're going to have to cut us a check for X dollars. There's all kinds of different ways that we could think about prices, and we can create these rules. Now, everything that you have done in the context of your, let's say, ERP SIM experience, and then also in your lab for this class, has been based on setting a single price for a product. You might remember, and I don't know if you've already done this lab or if you'll come back to it in the future, but sometimes you'll see on the pricing transaction, like all the way to the left, PR00, which is a pricing rule for this is what you sell this product for. Well, what you haven't ever done, but what you could do is you can have other pricing rules. And the idea here is I could put these into the system and allow the system to automatically do the appropriate calculations. Now remember, at this point we're talking about the buying side of this. So what we're talking about here is me putting into the system all of the facts that have been given to me by my vendors for the system to help me with this. Let's go back to your experience with ERP SIM. You put in a sales forecast. You ran MRP. The MRP process created purchase requisitions. You ran a transaction, I believe it was ME59, that automatically converted your purchase requisitions to purchase orders. Remember that? That was a step that a lot of times teams would forget and then wonder why they never got stuff. Well, what happened when you ran that ME59 transaction? In ERP SIM, it was a really simple evaluation because you only had one vendor that sold each of the products. So the system basically said, oh, you need blueberries. There's only one company that sells blueberries. Guess you're going to have to order from them, and it would do the assignment. But in a more realistic environment, that same transaction could have a variety of vendors available and a variety of pricing conditions that it would then evaluate and say, okay, you need to buy 5,000 kilograms of blueberries. The best price based on the rules that we have and the pricing schedules that we have been given from our vendors, the best assignment based on the given conditions is to buy them from this vendor. So the system will evaluate this in that particular transaction based on these conditions. So what are the scenarios here? Well, I can have what are called contract conditions. Now, a contract condition is a price that is derived from a particular contract that I have with a given vendor. I'm going to be hypothetical about this, but I believe that it is true. Well, somebody help me with this. When you go over and eat lunch in the cafeteria, is that Coke products or Pepsi products, or is it both, or one of them? Coke? So I thought it was. It is very, very likely that Sodexo has a contract with Coca-Cola that specifies that they will not sell Pepsi products. And based on that contract, and based on statements that they have made about how much they expect to purchase and so on, Coca-Cola has a contract that quotes them a price. Well, in this situation, that contract might say things like, we have to buy at least this much Coca-Cola from you every year. And so when we place a purchase, the system's going to look at that and say, okay, we haven't fulfilled our contract yet, so we have no latitude here. We have to order from this particular vendor, and this is the price associated with it, and so contract conditions apply. We don't always have a contract with every one of our suppliers for all of our products, but it's very common for us to have that for products that we buy a lot of or products that are very critical for us. So when you see the term contract conditions, the idea is we actually have a formal arrangement with a particular vendor to buy products from them, and in the contract, there's a pricing schedule and a set of criteria associated with how that will be calculated. Yes, sir. Roger.
It seems like it'll be a good leverage of the concept of buying supply and demand and concept. Then conditions like magic person say, ooh, either way, if the market price is this and people are supply this much, to buy this much, then I'm buying this way and this person is probably around that.
Without overcomplicating this, let me give you an example of what you're talking about that a lot of companies have run into problems with this last year. And I'm going to use made-up numbers here. Let's assume that my company buys a lot of gasoline because we have a whole fleet of trucks. And so we go out to, let's say, ExxonMobil, and we say, this next year, we believe we will use 1 million gallons of gasoline. And we agree that we will buy that 1 million gallons from you. What price will you give us? And I'm going to make something up here. Exxon might come back and says, okay, if you're going to buy 1 million gallons of gas from us, we will sell it to you for $1.25. But you have to sign a contract saying that you'll do that. So we sign a contract with Exxon and we say we'll buy 1 million gallons for you at that price. Well, then life happens and economic factors happen. And on the free market, regardless of our contract, the price of gas drops, and now any old person can buy gas for $1.10. Well, guess what? We're stuck paying $1.25 a gallon for gas until such a point as we buy 1 million gallons, which means that we've actually done something very, very counterproductive, and that is probably going to hurt our competitiveness because we've locked in a price higher than everybody else. Now, if the market forces shift and everybody else starts paying $1.40 a gallon, then we look brilliant. And so, yeah, this is where economists and this is strategic purchasing at its highest level really look at this. I can tell you that we had a ETSU student graduate a couple years ago and went to work for a company doing data analytics work. And his first project actually related to fuel purchasing. And he was able to do some calculations and bring together some data for that company that enabled them to save the next year, I believe it was over $3.5 million. They really, really liked him, and he got a nice promotion as a result. And it was this exact scenario. So, yeah, that's where contract conditions absolutely come into play and could be great for us or could wind up with us shooting ourselves in the foot. Purchasing information record conditions. We just talked about purchasing information records a few moments ago here. The idea here is this applies to orders based on data in the purchasing information records. So let's just say, for example, that a given supplier tells us, hey, look, we will give you, and this is very, very common, we have different schedules for our customers. And if you buy up to X dollars from us in a given year, you're a Schedule A customer. And then if you buy more than that, you're a Schedule B. If you buy more than that, you're a Schedule C, and so on. Sometimes the letters work in the opposite directions or so on. And so it's not so much what we buy on an individual basis, it's what we buy on a set of purchases. And so we have the ability to go in and memorialize certain things like that in purchasing information records. We also have a lot of what I have been describing here would be considered extended conditions. And this is applied only if certain criteria is met. So maybe we calculate the price, but perhaps there's another condition that comes into play where they say, oh, since you've bought this much, you also qualify for this discount. And the idea here is that these pricing rules, you could have multiple rules that all contribute to a price you're actually going to pay. So we put these conditions into our system as they are quoted to us from various suppliers so that when we do assignment of vendors, we let the system help us figure out who we should best order these things from. So almost universally, when you see the word conditions, you should translate that into the word pricing. Now, having said that, let me give you the exception to the rule. The term output conditions is a valid term that you will often see used, but it has nothing to do with pricing. Output conditions is a term that describes the document exchange between us and other parties. And it includes things like, are we actually going to print it on paper and mail it to them? Do we fax it to them? Do we do electronic data interchange? What should the actual format of the documents look like? Those things all fall into the category of output conditions. So the only reason why that's part of this is because, you know, be aware that that's the exception to the rule that the word conditions applies to things related to pricing. Questions about any of that? All right, so we finally finished all of the master data related issues related to pricing, and now are related to procurement. Now we'll talk about some concepts as it relates to procurement and the execution of the process. Item categories are very important to us. You most likely, when you think of purchasing, think of what would be called the standard item category. The term item categories is used to describe the process by which we procure the materials. And in this sense, we don't mean process in terms of we load it onto a truck and drive it from point A to point B. We mean more the broad overlying strategy by which we buy things. So the standard process is I send you a purchase order, you send me the materials, I own them, I can now do what I want with them. I can sell them to someone else, I can use them to engage in manufacturing. That's the normal way that purchasing happens. Party A and Party B come to an agreement, there's an exchange of materials, there's an exchange of money, and the transaction is over. That's probably most of the kinds of business transactions you have engaged in, and that's typically the way most transactions happen for most businesses. But there are some differences. One other way that we could handle this is consignment. Some of you perhaps have shopped from a retailer that engages in consignment. Can anybody give an example of where you perhaps have seen this? I'm sure all of you buy this on a regular basis. Maybe reality is you went with your parents or your grandparents to an antique store. And when you walk into the antique store, there's all kinds of stuff there that I'm sure you were very interested in. And everything there is very likely to actually be a consignment item. You also see this sometimes in clothing. Used clothing stores often operate on consignment. Well, what's consignment? Consignment is, okay, I am the buyer, and we'll go with my dresses example. I want dresses to put in my store. And so I have companies that I deal with that provide these to me, and then I have individuals that just come in and say, I would like for you to put my dresses in your store for customers to buy. I take in those materials and I put them in my store. I hang them on mannequins, I put them on hangers or whatever have you. I put them out for display. But here's the key, I don't own them. Someone brought them to me and I'm displaying them in my store in hopes of selling them. If I actually do sell the item, here's what literally happens. Well, here's what happens logically, maybe not literally. The customer goes over to the rack, picks up a dress that I don't own, brings it up to me at the cash register and says, I would like to buy this dress. And we say, great, we would love to sell you the dress. I take the dress from the customer, I buy it, I run it through the cash register, and I collect money from them. I take ownership of the item the instant before I sell it to the customer, but not before. The property is owned by the vendor until such a time as the sale takes place. And instantaneous with that sale, title transfers to me so that I can transfer ownership to the customer. So what does that mean? There's no invoice in this transaction. You have to, if you're the provider of the dress in my example, you have to make sure that you're dealing with an honest business. Because what has to happen is, periodically they contact you and say, hey, last week we sold 5 of your dresses. And we have an arrangement with them that once we sell the dresses, then they get paid. So they delivered 5 dresses to us, and they told us, when you sell them, you got to pay us $100 for each of those dresses. So we come up and we say, yeah, you know, you dropped off 50 dresses, 45 of them are still sitting here, but we sold 5 of them, so we're mailing you out a check for $500, okay? So in consignment, the party that's holding the items and making them available to the customer doesn't actually own them. They're owned by another party that gets paid right before, or that gets paid after the sale to the final customer. So there's a number of interesting things about this. I already said there's no invoice receipt. I don't get a bill from the other party. I have to keep track of what I sell and who I should be paying money to, and then it's up to me to send the appropriate party a check. So there's no invoice. The other thing that's interesting is, when you look on my balance sheet, I don't own what you see in my store. So that's not an asset of mine. I'm kind of just saying, I'm going to provide a room and people can put stuff up for display, but I don't own it, which means that I don't have insurance on it, which means that if my store burns down, I don't have any stake in that except for the building itself. So on my balance sheet, I have a very, very lean operation as far as investments in assets. Now, I said a moment ago, you've seen this model in antique stores and in dress stores. Another category of business that you might be even more familiar with, car dealerships. Go to a car dealership, and on that lot, there could be a few hundred cars. You think that car dealership owns all of those cars? That'd be an awful lot of money for them to have to part with. They don't own those cars. Those cars are shipped to them from Nissan or Chevrolet or whoever in a consignment type operation. Now, there's one other thing that goes with this in the car dealership business. They have to pay rent back to the manufacturer for the cars that sit on their lot. But they're just renting those. They're kind of paying for the privilege of displaying it. And like I said before, they don't actually take ownership of it until right before they sell it to a customer. Yes, sir. Well, you're going to pay taxes related to, you're going to collect like sales tax from the customer, and you're going to make hopefully a profit as an organization that you're going to be taxed on. So the tax man's going to get his or her money, as the case may be, but it's not going to come from the assets. Now, your arrangement with the manufacturer might stipulate that you have to carry certain kinds of insurance. I did my doctoral work at Auburn University, and in Auburn, Alabama, I don't know why this was, but we went for several years where it hailed a lot. And it was great if you wanted like a cheap car and weren't so focused on what it looked like, because after a big hailstorm, they would have, you know, like hail dent sales where you could buy a car with a significant discount. And I know that those car dealerships used to have to carry insurance for that. And that would be required by the company that provided the vehicles to them. There's kind of a, here's like a trivia question. If you've ever watched the movie Fargo, you remember the guy who works as a salesman at the car dealership? I don't remember the character's name or something. He was having all kinds of trouble in the movie because the car manufacturer kept calling him and asking him to provide the VIN numbers for cars he was supposed to have on his lot. And he was running a scam where he was selling the cars and not telling the dealership and just keeping the money. That's not what you're supposed to do. You know, the idea here is you You have to run these equitably. I don't know if you ever watch any of those like court shows on TV. I used to watch the People's Court, and it seemed like about every fifth case was someone who delivered something to a consignor and then accused them of being dishonest in the way they dealt with it. So you have to be real careful in these kinds of relationships, but it's a perfectly valid way of doing business. So once again, the big picture is here. I am taking possession of something, but I'm not taking ownership of it. And so I'm not actually paying the other party who has given me the item until such a time as I sell it. And then at that point, we basically, you could think of it as we split the proceeds of that sale. So I don't ever get an invoice from this third party, and in terms of my balance sheet and accounting records, I don't value this as an asset for my organization. That's a way of buying things. Subcontracting. Subcontracting is when I buy stuff that I already own, which seems kind of weird, but the specifics of this is I have a material, and I'm going to send this material that I already own to a third party for them to presumably do something to it, and then they will send it back to me. So let's stick with our car example. I own a car dealership, and I want to have a special paint job done to one of my vehicles by a local paint company who does really deluxe paint jobs. So I ship them a car that I already own, and they do the paint job, and then they ship it back to me. Well, what's actually happened in this situation is subcontracting. You know, normally when you think about buying stuff, you think about a goods receipt. Well, I already had the item in my hands before we entered into this arrangement. And so what actually happens here is instead of there being a goods receipt, there's an outbound shipment of materials that I have to provide to the vendor, and then they're going to do their thing, and then they're going to ship it back to me. So it's not an unusual situation. I think it's pretty logical to understand what's going on here, but the logistics are different. It's not the typical logistics of you send me stuff and I send you a check. This is a scenario where I'm sending you stuff for you to send back to me, and then ultimately we pay for it. This can happen in a wide variety of ways. I know, for example, a company I used to do business with, it was a printing company. They did not have the equipment to do hardback binding of books. So when they wanted to do a hardback binding of a book, they sent their books to another company just to have the hardbacks put on them. That'd be a subcontracting kind of situation. It's a kind of purchasing that we reflect in an item category in our records. Third party. This is more commonly called by a lot of people drop shipping. The internet has made this method of doing business very, very common. In drop shipping, we buy something from a vendor, but the vendor does not ship the item to us. The vendor ships it to one of our designated customers. So here's the scenario. I am Dell Computer. People order monitors from me. They order printers from me. They order a wide variety of things. And although I have a lot of things that I sell that are the Dell name brand, maybe I also, and I'm being hypothetical at this point, maybe I also sell HP printers. And I don't keep HP printers in my warehouse, but I sell them on my website. And so if a customer comes to my website and orders an HP Model 127 printer, they pay me, I collect their money, I contact HP, and I say, HP, put an HP 127 in a box and ship it to Bob Smith on 112 Elm Street in Johnson City, Tennessee. And Bob Smith gets his printer and is happy. Now in this scenario, Bob Smith probably doesn't know that me, Dell, never even saw the printer. that he got. He doesn't care. He knows that he paid me for a printer and he got his printer. But the logistics of this is one party gets the money, they place the order with a third party who then ships the item directly to the customer. That's called third party purchasing. As I said, that's called drop shipping as well. There are an awful lot of online businesses that this is the core way that they operate. I actually had a friend who graduated undergraduate about the same time I did, and he started a business like this where he was selling, as I recall, some kind of industrial products from his apartment. And he never had a warehouse, and he didn't need a warehouse. He would go out and call on customers and sell them stuff, and then when they ordered it, he'd turn around and order it from another company and have it shipped to them. And of course, what happens here, and let's go back to my Dell example, HP sends Dell a bill for the printer, and of course, HP has collected presumably more money from the customer, so the money that's the difference between what they have to pay HP and what they got from the customer represents their gross profit. Yes, sir.
I know certain examples with some kinds of electronics. A lot of times they have a sticker on the inside of the box that says, "Don't contact 6 o'clock from Best Buy. Don't contact Best Buy for this product. Contact us directly." And I would assume it's something related to their business.
It could be. It doesn't necessarily have to be this. You know, there are also maybe sometimes you've seen where some companies have what they call authorized resellers, and yet there are companies that are selling their products that aren't on the authorized reseller list. In most cases, that's not against the law, but it's against the wishes of the company. And so sometimes they put things like that just to direct customer behavior or try and influence customer behavior in a particular way. But almost never is it a formal business requirement. You know, a good example of this would be you go to Sam's Club and you buy something in a bulk package, and maybe you see a label on the inside that says, not for individual resale. Well, in most instances, if you decided to ignore that and sell those on an individual basis for someone, it's not like the police are going to show up and arrest you. The manufacturer is just telling you, we don't want you to do this. And they're going to kind of try to, if you will, intimidate you into not doing that by putting that requirement on there. But they can't force, you know, they can't dictate what you do with the product after you buy it. So the scenario you mentioned where it says, you know, don't contact the retailer, a lot of times that's where Best Buy has worked out a deal with them and said, look, we don't want people bringing these back to our store. And so the manufacturer puts that in there just kind of as an incentive to get Best Buy to carry the product in the first place.
What kind of brought up that question was that you said that a lot of times, for example, in Dell doesn't use HP printers. So what I instantly thought of is whenever Bob gets the printer's broken, so he calls Dell, and Dell's like, well, I don't know anything.
Now, you bring up a real good point there. In Dell's situation, Dell doesn't even want you to know about HP and their relationship. So if they call up HP, you know, if Bob calls up HP, or if Bob calls Dell and says my printer's broken, Dell will help Bob get the problem resolved. And Dell will probably say, okay, put it back in a box and send it to this address and we'll send you a new one. And then they're just going to contact HP and have HP work that out. Because usually businesses that are good realize that you don't want to give the customer an unnecessary hassle. And if Bob called Dell and Dell told Bob, hey, take it up with HP, Bob's probably going to go on Facebook and post a nasty review that all of Bob's friends are going to see, and companies try to avoid that. So what typically happens in these third-party situations is the third party is totally hidden to the end customer. You don't even know they're involved. And the reason why I used HP as an example, and I'll tell this story and we'll be done, in the very early days of e-commerce, Dell worked out a deal with Sony, who made their monitors, and with, it might have been HP, I forget the other company who made their printers, to drop ship things directly to customers. Dell would make the CPU, but the monitor and the printer would come from another company, and they'd be drop shipped to the customer. So the customer would go online and buy a bundle, not realizing that the CPU might be coming from Texas, the monitor might be coming from California, and the printer might be coming from, I don't know, Maine. That's not likely, but in my example, Maine. And it caused confusion because they would arrive in 3 different shipments. And I might get the monitor on Monday, the printer on Tuesday, and the CPU on Wednesday. And so Dell actually went to UPS and worked out a new arrangement with UPS where UPS would hold the packages until they had all 3 of them and then make one delivery to the customer. And it was all to kind of mask that this was going on behind the scenes, not to cause customers confusion. All right, well, this is where we will stop for the day.